Hey guys, in this video, we're going to look at 7 stocks that had huge drops in the last week. If you like this type of content, please subscribe to the channel, hit the like button, it really helps the channel out a lot. And also would love to hear from you in the comments if you have any thoughts on these stocks or any other stocks that you want me to talk about. Now, when I say stocks that have dropped a lot this week, I'm talking about stocks that are down minimum 10% over the last 5 days. And we're going to go into each of these a bit. I'll give my thoughts on these stocks, talk about where I think there may be buying opportunities, overreactions versus what ones I'm just staying away from. The first stock I'm talking about that dropped over 10% this week is Chewy. So, Chewy is a pet care company, e-commerce company primarily, that ships food and so on to you know pet owners' houses. They're also trying to get into pet healthcare, but this is just a very expensive company to begin with. So just looking back over the past year, the stock's down 26%. In the last 1 week, it's down 12% behind their earnings. Market cap is $14 billion. And if we look at what they deliver, their sales aren't too bad, about 10 billion. But remember, this is direct to consumer shipments of heavy items for the most part in their core business, I believe. So it's very low margin, and you see that come through. On $10 billion of sales, they made 0.5% in net income. So under $50 million of net income on over $10 billion of sales. So $10 billion of sales for a company doing $14 billion in value doesn't seem that bad, 1.5 times sales. But when you look at their ability to turn it into income, it is a very expensive stock. And I think obviously the assumption into lots of the investors' heads here are with scale and with time, they're going to be able to get higher net income margins. And hopefully this gets into, 100, 200, 300 million, etc. over the next couple years. But to justify a $14 billion value, like I need to see a reasonable medium-term line of sight to like $1 billion of net income. So this 20xing, just to justify this in my head. So this is a stock that I think was very expensive to start with. If you look at their results, just on top line, they grew 13%. Net sales per active customer is super impressive to me, $500 a year. So I'm thinking that's, $40 a month. So they're truly getting like a subscription service going here. Their active customers, 20 million active customers, are spending a lot of money on the platform. It's just they still need to make significant strides in profitability. Another thing on Chewy that's interesting is in the earnings call, they talk a lot about positioning the company not only to be a consumable company, so food, I believe, but also like medical services and healthcare for pets. So they talk about that a lot in terms of how that really goes side and side with their objective of increasing quality of life of pets, giving them food that'll let them live longer, and then also giving them healthcare that'll help them in their later years as well, or as things come up. So it seems like the market's not fully buying that vision as of yet, and it's just too far away from actualizing with the stock down over 10%. I think they should probably figure out their core business profitability before potentially spending capex and becoming less profitable by investing in a new avenue. But I do think like theoretically that does make sense for them eventually. But this is one that I'm just not interested in given the $14 billion valuation for a company that's pretty much break even right now. And it's not like they have explosive growth. They grew 13% last year. Going on to stock number 2 that was down big this week, it is Coinbase. So Coinbase is obviously let's call it a brokerage for cryptocurrencies, which have gotten hit really hard over the last couple years. If we go to a year to date, they actually rallied behind the potential slowdown in interest rates. So up 100%. This one's super volatile. Rarely do you see a company up 100% in the past 3 months, but down 64% in the last 1 year. So you get a sense for how all over this company has been. but we're focusing on the last week. What happened in the last week was an SEC warning on some of their lending services, I believe. And I think, yeah, this is obviously not ideal, but just with everything going on with cash calls on banks and stuff like that, anything that's involving lending is getting a bit of a scare with investors, especially equity investors, given some stocks have gotten completely wiped out on the financial side. My personal opinion on this name, they have been losing money 4 straight quarters. Their revenues even have been declining. Very cyclical to a crypto market. If I thought that crypto was going to go on a big run, I'd probably just buy Bitcoin or Ethereum and not have to deal with these underlying losses and eventual like debt or share dilution that would take place. So like I don't see value in owning the company. Um, the drop may be a bit overstated, but in total, like if this stock went down to $20, I probably still would just buy crypto, and I just don't really have interest in the cryptocurrency brokerage space. So not a lot of thoughts on that one, but it is a big decline for anyone who may be interested in owning an asset or a company like that. Going into the third stock, Footlocker. So Footlocker dropped 14%. Footlocker, it's surprising how small a company on market cap Footlocker is. Just, it's always been around. It's in tons of countries. $3.5 billion market cap. They also own the Champs brand that you guys may be familiar with as well, trading about 10 times earnings, pays a 4% dividend yield. I believe they buy back shares as well. So really shareholder focused. If we look at their earnings, they weren't great. Total sales flat. Comparable sales per store up 4% below inflation. They are profitable. Made $1 of non-GAAP EPS, 20 cents of GAAP EPS. I hate when there's such a significant delta between the two. It makes me need to go in and look more at what's driving a 5x difference. But ultimately, for next year, they're expecting about $3.50 of EPS, let's call it. So they're trading, right around 10 to 11 times earnings. A reasonable valuation. But if you look across the retail landscape, there's tons of companies that are trading anywhere from 8 to 12 times earnings. So cheap versus the overall market, but probably where they deserve to be within their industry. One thing that may have spooked investors a bit to get them to that minus 15% on the week is they announced during their earnings that they plan to close 400 Footlocker stores and I think 120 Champ stores in the next 3 or 4 years. I think part of this, or part of the rationale behind the closings, where they were going to focus these closings on mall locations. So kind of speaks a bit more to the death of the mall or the conventional mall to a certain extent. And it looks like that freaked out investors just because I guess Footlocker over their history has had such a big part of their business coming out of malls. And I think they've talked about focusing on that years ago. So it seems like they've kind of admitted that they're going to be a lot more selective in that area. It's not the future. And maybe raise some questions on if they are positioned well over the next 3 or 4 years as they wind this down. Also, what costs are associated with winding this down. So overall on Footlocker, I think it's a fine company to own if you want a retail play that's in more discretionary products. 10x earnings, 4% dividend, buying back shares. It's not one that I'm interested in. I have other retailers that are on my watch list that trade at similar or lower values that if I wanted to make a play into this space of retail that I'd prefer. Let's see how they've been doing past 1 year. Yeah, they've actually done pretty well. I think they got hit really hard on the backdrop of COVID. And now they're kind of rebounding before this week's earnings report. Okay, going into stock number 4. So Square. Square had a tough week. You can kind of see where it happened, down 18%. So a activist investor came out short short sell the company. Sorry, choked on my words there. But they bring up a lot of interesting points. Their whole theory was around how Cash App is not regulated enough, should be more regulated, and lots of the profit buckets, gross profit that's stemming from Cash App that's fueling the company is being generated in ways that they wouldn't be able to generate it if they were regulated correctly. They also accuse Cash App of being complacent in facilitating fraud, which, just isn't good to have out there to have as a perception on your company. And just lots of other things around the leadership team, how they took out a bunch of money and sold a lot of shares when the stock was high. I think that's more optics than something that's actually relevant. But just generally speaking, it was a lot of different points they covered. I'd say the Cash App facilitating fraud and the regulatory status of Cash App were probably the biggest two. And I think on this company here, my opinion on it is Block has some amazing, plays in an amazing space, amazing potential long term, but it's really would be a flyer in terms of betting on them to actually execute, actually move into the new wave of banking and personal finance with millennials and consumers. I like their payment processing, the bricks and mortar retail side of their business. The Cash App business probably has a lot more opportunity, but also a lot more risk. They compete heavily against Venmo. It's a lot of other big tech companies trying to get into the payment space and the wallet space. I think only a couple of them will end up winning out. So I think this is kind of a flyer on fintech. If you were looking for a 20% discount to manage your risk reward to get into that flyer, could be an opportunity, but not one that in this environment with like 6% interest rates that I'm interested in parking money into, just as they don't kind of generate reliable cash flows. They also don't pay a dividend, don't buy back shares. So not for me on this one, but could be an interesting opportunity for someone who is looking for some fintech exposure and has an opportunity to get it 20% on deal. With that being said, if like an SEC follow-up on this occurs with them looking into the regulatory status of some of these fintech companies, that could be a significant farther drop for Block. So maybe average into this, maybe my advice or my thoughts of what I would do if I was to get into Block. Okay, stock number 5. So PetCo, health and wellness company, similar to Chewy, except they operate retail stores. They also, I guess, do mail order supplies in certain states, but they're a big company, 1,500 stores across the United States, Mexico, Puerto Rico. They, similarly to Chewy, dropped big this week. So at least PetCo has, a more reasonable valuation, actually trades at 22 times. Significantly smaller company, about 1/7 the size of Chewy, despite having an actual retail front, having what looks to be more profits, which is interesting. But just looking at their report a bit, they only had growth of about 4% in the fourth quarter. They saw comparable store sales climb 5%, 18% on a 2-year basis. So it looks like they had a really good 2021. Profits decreased to $627 million on a gross basis, and then on an EPS, they had EPS of 23 cents for the fourth quarter. So I'm just looking. No, they don't have full year here. But on this stock, they also talk about getting into wellness as well. If I just go back to this article here, it really talks about both Chewy and PetCo CEOs making it clear that healthcare is the future of their companies for pets. So similar sentiment from investors, not really cheering that news, maybe not knowing what that's going to look like, how much is that going to cost, what's competition look like in that space. At the end of the day, these are currently just like retailers selling food and Chewy and toys and stuff like that? Can they really get into the healthcare space? So this is another one that I'd probably be closer to investing in than Chewy, just because actually spins out more net income and cash flow relative to its valuation. But at 22 times earnings for at the end of the day, a pet retailer, after we've just gone through kind of like a pet boom during COVID, um, this is one that I'm not really excited about, or I don't have on my watch list. I still think it's probably too expensive on a multiple basis. Crazy to see it drop 20% and still be significantly more expensive than where I'd look to get into it. That's just my thoughts on the pet care space overall. Maybe, it's a lot more category growth here than I'm anticipating, but I'm just not willing to pay these multiples with no capital return to shareholders. Going on to stock number 6. So Scholastic Corp. As some of you, doesn't have their thing here, but as some of you may know, Scholastics from when you were a kid and you were kind of like picking up stuff from the flyers to send to your homes from school. But they do a couple other things, but ultimately they had a big drop this week, down 22%, currently trading at 19 times earnings. They do pay a dividend, but they are a small company, $1 billion market cap. If we look at what happened, they had a huge reduction in forecast. So it went from 8 to 10% guidance on revenue growth to 4%. So more than cut in half. And then their EBITDA took a nosedive from 200 million to 175 to 185 million. So about 10% drop on total absolute EBITDA, 50% drop on revenue growth rate. So really bad guide. And then I think they actually missed the quarter pretty bad as well. So CEO said Scholastics navigated short-term headwinds in domestic and international markets, which contributed to modest sales declines and higher losses in our seasonally small third quarter. So they're kind of talking about headwinds, whether that's cost pressure, the consumer, whatever it may be. This is a stock I'm actually shocked it trades at 19 times earnings, given the space and the discretionariness of where they operate. This is not one that I personally am interested in touching. I just found it interesting to see this company come up after all that time. I didn't even know it was a public company. And unfortunately for them, the thing that made them come back to the forefront to me is the fact they dropped 22% in a day, 25% on the week. So this is one that I'm not too interested in. If I was to look back at stocks out of these ones that I'd be the most interested in so far, it would probably be Footlocker, and then that's probably it in terms of what I'd realistically consider, and I'm not even that close to that one. So far, all of these are just FYIs for me. Good to know, but not at the point that I'd want to invest in them personally. The last stock today is First Republic Bank. So First Republic Bank was kind of the next domino to go after to fall after Silicon Valley and Signature and all of those banks. And it's still kind of surviving, but we've seen now a couple weeks in a row of significant declines. What's interesting is if I look at the regional bank index over the last week, it's actually stabilized. It's about flat. I think it's actually up 1%. So we're really starting to see people get into the nitty-gritty, try to figure out which ones of these companies are good buying opportunities on the dips versus which ones actually have some existential risk associated with them. And obviously from the last week, lots of investors and analysts think First Republic fall into that second category of significant risk. This one's interesting, and I don't know all the details, right? But I'll follow the market on this one and just not touch it. It's kind of like gambling. But they have been getting cash infusions from JP Morgan, these big banks. And I find it hard to believe that a bank that had a market cap before all of this of like $20 billion, they cannot have their deposits covered by these big banks if they wanted to step in and help. So I don't know if they're going to dilute them. They're going to ask for equity, what the terms of these agreements are. But it seems like they have some powerful partners and support. to keep this bank afloat. Now, I don't know if that'll actualize like Silicon Valley Bank did, where the depositors are protected, but the equity holders end up getting wiped out. Maybe that's some of the fear here, since equity holders got none of the love in some of the other banks that went through this. But this one's definitely interesting, down 90% on the month. Um, so if you want to gamble on it, you could. Paying a 9% dividend yield, but I don't know if they're going to be paying that out. Just not one that I'm touching. If I wanted to gamble to this extent, I'd just go to the casino. So those are the 7 stocks that are down over 10% this week. Let me know in the comments if you're buying any of these, if you have any thoughts on any of these companies. If you like this type of content, please subscribe to the channel. Give me a thumbs up. Really appreciate all the support, and I'll see you guys in the